What's up, guys? Let's have a conversation about profit margins as it relates to a physical therapy private practice. I'm going to share some numbers from US Physical Therapy. I've shared these numbers every year for decades now, sometimes privately within my group, sometimes publicly on YouTube. You can go back and find some of the old videos, but I think it's great to benchmark yourself against established businesses to see how you're really doing. And I'm going to tell you that most therapists, most private business owners in the profession of physical therapy artificially inflate their numbers. I think it's unknowingly. I don't think you realize just how small the profit margin actually is if you back out all the related costs that you're doing for your business. You're managing your business. If you hired somebody to manage your business as well as you do, how much would you have to pay that person? That is an expense that comes out of what should be figured in when you're calculating a profit margin. So let's take a look. I'm going to show you actually how to actually find this information. Let me, for some reason, I didn't have this formatted properly. Okay, so if we go to USPH Financial Report and we go into their website for SEC filings, let me get some more space. Whoops. Some more space over here. There we go. We're going to look at the 2020 10K. I know this looks just like a ton of gibberish, but I tell you what, you can really gain some useful insights from their annual reports and filings. I love stuff like this. Like if you look here, items 1A, risk factors. This will talk about the identified risk factors to the business, to the profession. This is going to be risk factors that you're dealing with also. There are some really great pieces of information in here that I'm sure you're taking into account. You know, like here, they talk specifically about MPPR. Therapists are asking me about MPPR all the time. They don't fully understand what it is, why it's affecting them so greatly. But you know, if you read the annual report for a company like this, I'm trying to resize this so I get everything we need on here. You will see this information. It's absolutely public information. Hang on a sec, guys. I wasn't ready. Okay. But what we're going to look at specifically is, let's jump down to page 46. And this is where we're going to look at some of these numbers. Looking at net patient revenue, this is December 31st, 2020, compared to the same 12 months previous year, 2019 and 2018. These numbers are in thousands, so when you see 373,000, it's actually 373 million. But we can come up with some rough percentages based on what we see here. So taking a look at this, right, we've got our net patient revenue, 337. Okay. We come down here and we look at salaries and related costs. That accounts for 235. If we do a little quick calculation, 235, 337, 235, 337, 69, almost 70%. Almost 70% of gross revenue is covering salaries and related costs. I mean, that's massive. Now, granted, that was 2020, right? The year of the pandemic. If we jump back a year, we go with 274 and 433. 274 and 433. We're looking at 63%. Still, more than 50% of gross revenue is going to cover the cost of salaries, which includes clinical salaries, administrative salaries. You know, that's huge. Like, and these guys have economies of scale. These guys can hire. They hire at relatively low paying price points. They're not like a small niche provider like you or I. They're paying their therapists at or below average rates. Then we come down here, we look at rents, supplies, contract labor, and other. That accounts for 84 million. We've got credit losses, closures, none of this stuff really, you know, salaries and related costs, rents and supplies. Those are going to be the two main ones that we're looking at. And when we add those two up, and I'm going to use the 2019 numbers because they're more appropriate. So we've got 274 plus 90. What I'm going to do here is I'm going to take this. I'm going to say equals parentheses 274 plus 90. Run that number. 84% of gross of what are they calling it? Net patient revenue. 84% is going to those two categories. And this is pretty typical. It really, really is. And then if you come down here, so we've got operating income, relief, taxes. They used to have corporate office costs. Here we go. Corporate office costs. That's another 45. So I'm going to come in here. I'm going to add another 45. And now we're at 94%. 94%. When I think of corporate office costs, they used to classify that as management costs, management related costs, I think is what they used to say. That's the thing. Like when you think of all the stuff that you do for your business, right? Somebody has to do the hiring. Somebody has to do the firing. Somebody has to review the numbers and plan for the future and organize the company in such a way that it's going to continue to grow and innovate and thrive in changing environments. Who's going to do that? Now, I understand you do that as the owner, but if you were a passive investor, just like somebody who bought a share of stock in McDonald's, I'm not sitting in on board meetings and I'm not cleaning the toilet. I am simply a stock owner, share owner. I don't know if McDonald's is paying dividends or not, but I would get passive income from that if they do. Otherwise, I just want my shares to appreciate. As a passive owner of a physical therapy practice, you should not be the one who's making those decisions. There should be a leader in place. Now, if you're going to be that leader, you're going to get paid to be that leader. But if you're not that leader, you have to deduct that income, right? So you're probably getting paid to treat patients. You're probably getting paid to run and lead the organization. But as a true owner, and if you're truly looking at the profit margin for the business, all of those expenses have to come out. My estimation in most cases is that the true profit margins probably like what you see here. 2%, 5%, maybe 7% on a really well organization that's got some cash cows that are just pumping out tons of cash with relatively low cost. You know, in my company, the therapy is great. I do it because I love it. It's a great, huge part of the business. And without it, I probably wouldn't have the success I have on the digital side, but the digital side is my cash cow. When I create a digital course, when I sell a digital product, that is almost 100% profit. So if I can make $100,000 in a year on the digital side with virtually zero expense, assuming I'm not marketing and doing other things, that would be the equivalent of $1 million revenue producing physical therapy practice that has a 10% profit margin. Because once those digital products are created, it's virtually zero cost to have them continue to operate and generate income. And so it's just astounding to think how much time and effort and sweat, blood, and tears we dedicate to patient care, when in reality, we could quadruple or 10x that number moving into a digital product world. And then that world would pay us to do the things that we love to do that ultimately lose us money, but make us happy, make us joyful, you know, improve our quality of life, which is helping patients achieve their goals. So think about this stuff. Go check out the annual reports for US Physical Therapy and any other companies that are publicly owned, publicly traded that you might want to learn more about. Read their prospectus, read their annual reports, read their shareholder letters. You will find a wealth of information, all totally free, all totally accessible. Guys, I wish you the best.